Good afternoon, all. Welcome to the latest in our line of Tax Tuesdays webinars. And today we're talking about the thorny subject of charities and the question that I hear quite often, which is that charities don't pay tax. Unfortunately, it's not quite as simple as that, and I can show you plenty of ways to make a charity pay tax if you should want it to. So we need to concentrate on not falling into any of the pitfalls that can lead to that happening. So hopefully by the end of today, you'll have some idea what you need to avoid. Questions, if you've got any, I will try to pick those up on the way through. So do put those into the Q&A box at the bottom of your screen. So we need to think about position with charities and basically how charities work for direct tax purposes. And the basic position is that UK established charities are exempt from an income point of view on either income tax or corporation tax, depending on their structure, on a number of items. And that's specifically rents and profits from land that are applied for charitable purposes, interest and dividend income also applied for charitable purposes, and trading profits, but only provided that the trade is either exercised in the course of carrying out the primary purpose of the charity or mainly carried out by beneficiaries of the charity. And in both cases there, the profits are applied solely for the purposes of the charity. Now, I suppose what we're saying with this is there's almost a twofold test here in terms of income. One is what type of income have you got? Have you got your rents? Have you got your interest? If it's trading, is it in respect of the primary purpose of the charity? And then you've got what happens with the money. And there's a subtle difference here between the first few types of income and the trading profits, in terms that for rents, interest, dividends, etc., the profits simply have to be applied for charitable purposes. And that could be for the benefit of another charity. If, for instance, you made a grant of money to another charity, whereas for trading profits, they've got to be applied solely to the purposes of this charity. So if we move outside of our charitable objects, we could end up with a trading profit. It's also very important with trading profits to really focus in on that primary purpose aspect. So outside of that, as we will see, the exemptions are much more limited. And it's therefore around trading that we generally see charities end up with tax liabilities. Of course, it's not just about income. We've also got capital gains tax. So this is on selling an asset that you've held for a long time. And again, there's an exemption for the charity. But once again, we have to apply the resulting gain for charitable purposes. So an awful lot of this session will be about trading and what counts as trading by charities and what might be taxable and what we can do about it. And to start with, we need to think about, well, what actually is a trade? And what's a trade has been established over many years based on case law and largely based on the so-called badges of trade. And this is really all about deciding whether we have got an adventure in the nature of a trade carried on a commercial basis with a view to profit. And I think generally speaking, it tends to be clear when we've got a charity carrying out some sort of trade. There tends to be a profit-seeking motive. There tends to be an element of repetition in terms of what we're doing. And it's normally fairly clear that what we have actually is a trade. But what do we mean by primary purpose? Well, as we said earlier, a trade is exercised, is a primary purpose trade, effectively if it's furthering the objects of the charity. So an obvious example is educational services being carried out by a school in return for a fee. And we see that with private schools. Alternatively, you can also have the actual activities of the charity, the trade, being carried out by the charitable beneficiaries. So we see this in some charities where we have the sale of goods manufactured by disabled persons who are the beneficiaries of a charity that's to benefit disabled people. And if we meet these, then the profits should be exempt from tax as primary purpose trading, provided they are applied solely for the purposes of the charity. Alongside that, we do have various ancillary trades. And perhaps these are trades where they're not overtly primary purpose in nature, but they do contribute indirectly to the purposes of the charity. So thinking back to our school example, providing education to the children is clearly primary purpose. Selling textbooks to the students, that's ancillary to the main trade. If we were to think about a charitable theatre company, the sale of drinks to members of the audience at the bar, that would also be ancillary to the main trade. And the key thing with an ancillary trade is that the customer would be a beneficiary of the charity. And if that's the case, then an ancillary trade should also be able to benefit from the charitable trading exemptions. We do see plenty of things which are non-primary purpose. These we have to treat as a separate trade, not eligible for the tax relief and therefore liable to income tax or corporation tax. So if we had a charitable art gallery, then the shop is likely to be non-primary purpose trading, except where it is very closely aligned to the charity itself. Going back to our theatre, bar and restaurant, if that is open to the general public, so I can walk in without a ticket, then the element of sales to the general public will be non-primary purpose trading, therefore potentially taxable. And so we can summarize this here. And I think with those non-primary purpose activities, we'll look at some of these in more detail further on, but there are all sorts there that we run into difficulties with. So we see charity shops, which are selling various goods, raising money, but they're not actually primary purpose as such. Various types of sponsorship income might be trading. Short-term commercial lettings as well could be trading income. Sponsorship certainly is a particular issue we find for many charities. If you provide too much to the donor, so if you're making pretty prominent displays of their logo, allowing them to use the charity's logo, this is the sort of thing that can move us into taxable sponsorship. There is also a separate trading exemption for certain fundraising events, and I won't go into this in too much detail because it interacts with the VAT side that we dealt with separately. But fundamentally, if you can qualify for the VAT exemption, then you'll also qualify for a charitable trading exemption. Quite importantly, we do see quite a lot of situations where the trading that we have is not primary purpose. And therefore, we need to think about the exception for small trading. And this is a limited exception that basically allows us an exemption from tax up to certain small trading limits. And either for the period you can't exceed the limit, that I'll go on to in a second, or you can actually have a sort of transitional period and a get out of jail card, where at the start of the accounting year, you had a reasonable expectation that your taxable income would be below the limits, and then you can claim the exemption anyway. Now, the limit on taxable trading turnover to be exempt under the small trading thresholds is a greater of £8,000 or, it sounds complex, but the lesser of £80,000 and 25% of the charity's incoming resources. What that means in practice is it tapers between £8,000 and £80,000. This is applied to turnover, income, not applied to profit. Once your total incoming resources from all sources for a year exceed £320,000, you've hit that £80,000 top limit. Now, the problem with the small trading exception is that it's all or nothing. So if you go over the 80,000 and you can't claim that reasonable expectation that I talked about, all of your non-primary purpose trading income is taxable. It's not a question of just the top slice being taxable. So ultimately, if the charity meets none of those exemptions that we've gone through, the income will be taxable. Corporation tax if it's a charitable company, income tax, clearly at much higher rates, 45%, if it's a charitable trust. And I suppose that's an important point because we do see quite a few charities that are concerned about tax on income prefer to incorporate and be charitable companies so that the tax liability is that much lower. Now, just because we have a taxable trade doesn't necessarily mean that we have a profit for tax purposes. You know, we've got to make sure that we calculate that properly and put any applicable expenses against the trading income. And quite often, once you start to do that, you can find that actually your trading profit disappears. And one important point that we have with that is the so-called Peterhead principle, which arose from a case involving a local branch of the British Legion. And effectively, you had to calculate the tax liability for the charity with appropriate expenses and capital allowances, but taking into account the value of any gifts that were made to the charity. So, for instance, if the charity is only able to run this trade because of volunteers who give up their time and staff various trading activities for free, we would be able to value the time that they are putting in, and we would be able to claim that as an expense in calculating the trading profit. And the same if we were given donations of goods, etc., to sell. Now, we can still end up with situations where we've got taxable trading income after that, and later on we will go on to some of the possible solutions. The other issue we have to think about quite carefully is non-charitable expenditure. So this is not looking so much at the income side, but looking at how we spend the money. And what we find is if we have a situation where the charity has some expenditure during the year which is not exclusively for charitable purposes, then that amount of the income becomes taxable in that particular year. And there are some items that are specifically included in non-charitable expenditure. So for instance, payments to overseas bodies, you've got as a UK charity to take reasonable steps to ensure that the money is spent properly. You can't just make that gift. You can also find that making non-qualifying investments or loans is actually expenditure in itself, and that can be a big issue because of course you might be putting quite a lot of money into these, and equally if you then make losses on them, that could be non-charitable expenditure itself. To start with, of course, expenditure, what actually happens? Are we expending that money in the first place? We might be keeping some of our cash, some of our profits in cash, and it's rare that that's an issue. We said all the exemptions, we've got to apply the money for charitable purposes. It doesn't have to happen immediately, so we can keep some of that back. but we must make our investment decisions exclusively for the benefit of the charity. I explained, I'll breeze over this one, but I explained that if we have non-charitable expenditure, it results in a taxable profit arising, and there's an order of set-off to calculate that. So just by way of example on that, if we have exempt income of £120,000, so those are the taxable types of income, but on which we should be claiming an exemption. But we have a total income into the charity of £1 million, but we have non-charitable expenditure of £100,000, charitable expenditure of £800,000. Quite simply, the non-charitable expenditure set against £100,000 of exempt income, which becomes taxable. As I said before, we do have to be quite careful with investments because ultimately a lot of charities, they have cash, they need to invest it for the future. And if they were to put it into a non-qualifying investment, if you put £1 million into the wrong type of investment, that's non-charitable expenditure, £1 million of your income could become liable to tax. And there's a list there. There's a lot of things on there, but it does preclude trustees from making some more unusual types of investment. Equally, we see quite a lot of charities that might be making loans, potentially sometimes to a trading subsidiary, which we'll come on to shortly. But again, if the loan is non-qualifying, this creates non-charitable expenditure. So a qualifying loan is either it can be made to another charity for charitable purposes or to a beneficiary, because that's to do with carrying out the objects. Simple current accounts are fine. Or otherwise, any other loan, HMRC have to be satisfied on a claim that the loan is made for the benefit of the charity and not for the avoidance of tax. And that really means that it has to be made for the financial benefit of the charity to generate income to enable you to carry out your objects. So this is very important when you're making a loan as a charity, especially to a trading subsidiary, that actually we have to be able to show that we expect a sensible financial return on that we're going to be able to generate the appropriate interest and generate the appropriate repayment to enable the charity to have the money to fulfill its objects. And if not, it's perfectly possible that HMRC would turn around and say, actually, that £1 million loan you made, that's non-charitable expenditure. You've just lost £1 million of your charitable exemption for that year. If you're a company, currently 19% corporation tax, that's £190,000 of tax just gone out. If you're a trust, there's £450,000 of tax just gone out. So we've got to be very careful. Turning to a few other types of trading income, I mentioned sponsorship. So we have to think about what sponsorship is, because there are lots of things on the borderline. If my company simply makes a donation to your charity, that is not sponsorship if I get nothing in return. On the other hand, if I get something in return for my donation, potentially that could be trading income. We need to think about when we cross that line. Now, a mere acknowledgement of my sponsorship is not trading. So if somebody makes a large donation and you simply put up a plaque with their name on saying thank you, that's fine. The same if it went in the newsletter, etc. But if we move into the realm of advertising, then that is trading. So a large and prominent display of the sponsor's logo, a description of the sponsor's products or services in some kind of brochure on your website, etc. That could be moving into a sponsorship trade. Sometimes we see somebody sponsoring a particular event. And it's often about the level of exposure to determine whether that's a primary purpose trade by the charity or not. So we've got a couple of examples here. A local company sponsors a production by a local theatre group, a charitable theatre group. That's likely to be primary purpose. You know, we can allow the company's logo to be placed discreetly in the program, not too prominently. They might be able to put up a board with their logo on in the hall. Perhaps somebody will pose for photographs, but they don't get too much out of it. Then this is about funding the primary purpose trade, so it should be exempt. But in example two, we've got a nationally broadcast awards for an arts organisation. It's sponsored by brand Y. Ultimately, there's a lot of exposure there. The name comes up on television frequently, and HMRC are likely to believe that the main purpose of the event is advertising. And so that's likely to be taxable non-primary purpose trade. Now, I talked a little about the use of the trading subsidiary, and then this is very important as well, because what you will find very often is that a charity which will have taxable trading income will think about using a trading subsidiary to put that activity through instead. So this would normally be a company limited by shares, owned 100% by the charity. And the logic of putting a taxable trade into a trading subsidiary is that the company makes the profits and they're liable to corporation tax, but the company can make a gift aid donation to the charity that equals the level of taxable profits. The gift aid donation is deductible, so that can eliminate the company's tax liability. Now, where the subsidiary is 100% owned by the charity, as is the case in most cases, that gift aid can actually be paid up to 9 months after the year end and related back. And that means that we can actually sit down after we know how much profit the subsidiary has made and decide the amount of the gift aid donation to wipe out all of the taxable profit. It's not as simple as that, because the company may need to retain some of those profits for reinvestment, and that causes taxable profits. So it's not the Holy Grail, but we do see lots of them. We have to bear in mind sometimes the donation is actually restricted by the available profit and loss reserves. We can only make such a donation. It counts as a distribution, a dividend, for legal purposes. And therefore, we can only make the distribution if we have reserves available. Sometimes we find that we don't have those reserves. So that often happens if the subsidiary has invested, for instance, in fixed assets and there's depreciation going through. It wipes out the profit and loss reserve and means we haven't got enough to enable the donation to be paid, and we end up still having some taxable profits. It does increase costs and complexity, of course, and we have to think carefully about recharges between the charity and the subsidiary and deal with those correctly. It can give us a problem for VAT, and VAT is not a subject for today, and you can watch our separate Tax Tuesdays on charities and VAT. But there could be an issue. Equally, sometimes there might be an opportunity for better recoveries by splitting the VAT position. Financing can be difficult. I mentioned that earlier on, that we've got to be very careful with loans that we make to our trading subsidiary to make sure we don't have non-charitable expenditure. Do be careful. We normally will want a charity limited by shares, not by guarantee. I've seen issues with that in the past. I picked up a charity where this had happened and they were in discussions with HMRC because actually they were a charitable company. They'd set up a subsidiary but as a company limited by guarantee, and they had transferred chargeable assets, property to it, assuming that that was a no gain, no loss transfer as happening within a group of companies. Because the sub was limited by guarantee, not by shares, that wasn't the case, and we potentially had tax liability arising on the setup. So you've got to take very careful advice on setting these up and making them work. And I think there are circumstances where, frankly, the corporation tax bill may not be that high, even without the trading subsidiary, especially applying the Peterhead principle. And so sometimes it's simply not actually worthwhile doing. You do also need to think about the charity law position. I talked about the trustees needing to think carefully from a financing a non-charitable expenditure position, that the loan they make to the trading subsidiary or the investment in shares is fine. The trustees have also got to protect themselves from a charity law point of view. Is this an investment that you ought to be making? Are you confident that it's going to give you a good return and you're avoiding undue risk, etc.? So protect yourselves. Now, the final point I wanted to raise is just in terms of the disposal of land, because this is another elephant trap that comes along from time to time. Because most of the time, if a charity is selling land, then that's a capital disposal. We're claiming that capital exemption that I talked about at the start from capital gains tax or corporation tax on chargeable gains. The trouble is the disposal of land in some circumstances is not all chargeable gain, because there's a piece of anti-avoidance legislation, the transactions in land legislation, which is effectively anti-avoidance to tax certain disposals of UK property. And really that's trying to get at a situation where either the land was acquired with the intention of selling it for a profit. You can see that sometimes, but it's less likely in a charity, because generally you would have acquired the land either to use in the charity, in the furtherance of your charitable objects, or you've acquired it for long-term investment opportunities. But the legislation also applies where land is developed with the object of realizing a profit. And where that applies, this turns into income and trading income. And we know that it's probably not primary purpose trading income. And where we see this most often is where you enter into some sort of slice of the action scheme, perhaps with a developer, if you're selling land for development. We've seen this several times with charities. The point here is that the development to bring you within the rules doesn't have to be done by you. So if a developer is developing the land, but you are benefiting from that profit, not as a fixed price that they will pay you £2 million for your land, but if somehow you're benefiting from the development itself, i.e. you get a proportion of their profit, or you get paid per dwelling, etc., then part of this can become liable to tax as trading income. And so if you're selling land, if it's anything other than a straight disposal for a fixed sum, again, something I think that you need to take advice on. Now, that was a bit of a whistle-stop tour, but just to run quickly through the conclusions and elephant traps. Where can things go wrong? Well, I think it's not applying profits for charitable purposes. That can cause you a tax liability, or it's non-charitable expenditure. So it's spending money on the wrong things. That one comes and gets us. Trading. It's looking out for non-primary purpose trading, especially where it exceeds the small trading limits. And if you're relying on the small trading limits, it's monitoring those carefully. It's particular activities, especially sponsorship. If you get into trading losses, I didn't talk about those, but those are a beast of themselves. If you've got that taxable trading, then looking at the trading subsidiary may well be the right thing to explore, but it's not the panacea. You need to look at it very carefully in terms of all of those issues going on. And finally, it's looking out for land development. So disposals of land, and whether they are for a fixed sum or whether you might get dragged into those transactions in land rules. And if you can keep an eye out for all of those and make sure that you don't fall foul of them, then the statement start is quite correct, because then a charity won't pay direct tax. But those are all the ways that you can do. Now, we don't seem to have any questions in the box, but if there are any, be quick about typing them. Otherwise, you can contact me separately. We've got a number of upcoming events for our Tax Tuesdays. So on the 9th of November, Yvonne will be talking about making tax digital for income tax, which will be with us before we know it, and be a big change in the way that individual taxpayers have to deal with HMRC. On the 30th of November, Joe Boatfield will be talking about employee benefits, and keep abreast on our website of other upcoming events. So we don't seem to have any questions. So as ever, thank you everyone for attending. If you have any questions, anything we need to look at, get in touch. Otherwise, thank you and enjoy the rest of the day. Thanks.